Most people do not notice the problem when it begins. They notice it years later, when bills that once felt manageable have quietly taken over more and more of the household budget. For decades, insurance sat in the background of American financial life. It was something you paid because you owned a home, drove a car, had a family, or needed a health plan. It mattered, but for many households, it was not the bill that caused the most concern. Today, that assumption may be changing. For many middle-class Americans, especially those approaching retirement, insurance is becoming more than protection. It is becoming a growing cash flow challenge. And the difficult part is that it often does not look dangerous at first. A homeowner opens a renewal notice and sees a higher premium. A worker notices healthcare deductions taking a larger bite out of each paycheck. A retiree learns that Medicare still comes with monthly premiums. Another family discovers that having insurance does not always mean medical bills disappear. Each increase may seem manageable by itself, but the pressure changes when they arrive together. This is where the fault line begins. Many people think of retirement risk as one dramatic event: a market crash, a major medical emergency, a costly mistake. But for many households, financial strain builds in a quieter way. It builds through necessary expenses that rise slowly over time. Insurance occupies a unique place in household finances because it is often hard to avoid. A homeowner with a mortgage may not be able to drop homeowners insurance. Drivers generally need auto coverage. Retirees cannot simply ignore Medicare premiums. Families facing illness still need healthcare protection. These are not optional purchases, they are recurring obligations. And when several recurring obligations rise at the same time, financial flexibility begins to shrink. What looks manageable on paper can become much harder in real life. One of the clearest signs of this shift can be seen in homeowners insurance. According to the U.S. Treasury's Federal Insurance Office, homeowners insurance costs have been rising while availability has worsened in some areas. The report tied part of that pressure to climate-related losses. The important point is not that every homeowner faces the same situation. The important point is that insurance is becoming more expensive and, in some locations, harder to obtain. That goes beyond ordinary inflation. Data summarized from Federal Insurance Office findings showed that average homeowners insurance premiums increased 8.7% faster than inflation between 2018 and 2022. This is not just inflation. It is insurance inflation. And for homeowners nearing retirement, that difference matters. Many people enter retirement expecting housing costs to fall. Maybe the mortgage will be smaller. Maybe the home will be paid off completely. But the home insurance bill does not retire. Property taxes do not retire. Maintenance costs do not retire. Deductibles do not retire. The mortgage payment may disappear, but many housing-related expenses remain. That burden becomes clearer when looking at real households. In 2023, more than 5.3 million households paid over $4,000 per year for property insurance. That challenges the idea that insurance pressure only exists in a few well-known states. The problem is broader than many people realize. And homeowners insurance is only one part of the picture. Long before retirement begins, many workers are already carrying significant healthcare costs. According to KFF's 2025 Employer Health Benefits Survey, the average family employer-sponsored health insurance premium reached $26,993. The average worker contribution was $6,850. Those numbers help explain why some households struggle to accelerate retirement savings in their 50s and early 60s. That is often the decade when catch-up saving matters most. But it is also a decade when many people are helping aging parents, supporting adult children, paying down debt, or preparing for retirement. When insurance-related costs rise during those years, less money remains available to build reserves. The consequence is not always immediate. For many households, the pressure starts quietly. A little less goes towards savings, A little more goes toward fixed expenses. Year after year, that difference compounds. Then retirement arrives, and many people expect relief. After all, healthcare is supposed to become Medicare's responsibility. At least, that is the common belief. The reality is more complicated. One of the most persistent misunderstandings about retirement is the idea that Medicare is free. Medicare can significantly reduce healthcare risk compared with having no coverage at all. But it does not eliminate healthcare costs. For 2026, the standard Medicare Part B premium rises to $200.90 per month, up from $185 in 2025. That number matters because it reminds retirees that healthcare expenses continue after leaving the workforce. And Part B is only one part of the broader healthcare picture. Many retirees also face additional coverage decisions, prescription expenses, and other out-of-pocket costs. This does not mean Medicare is ineffective. It means retirement healthcare is not cost-free. At the same time, income often becomes less flexible. The Social Security Administration reported a 2.8% cost of living adjustment for 2026. Following that adjustment, the average retired worker benefit rises to $2,071 per month. For retirees, the question is not simply whether Social Security increases. The question is whether those increases keep up with rising fixed expenses. When several insurance-related costs increase at the same time, the extra income may not fully restore the flexibility that has been lost. And that word matters. Flexibility. The real risk is not one bill. It is the gradual loss of financial flexibility. A household with flexibility can absorb surprises. A household without flexibility becomes more vulnerable to them. That vulnerability becomes even more important when health problems enter the picture. Insurance can reduce risk, but it does not remove every financial exposure. Medical debt remains one example. In July 2025, a federal judge overturned a Consumer Financial Protection Bureau rule that would have removed medical debt from credit reporting. The details of that legal decision are less important than the broader lesson. Medical expenses can still create lasting financial consequences. Being insured does not guarantee complete protection from financial strain. A family can have coverage and still face deductibles, co-pays, uncovered services, or other expenses. That is why insurance should not be viewed only as protection against risk. It should also be viewed as part of the household cash flow equation. And for many Americans, that equation becomes even more difficult later in retirement. Because eventually, another issue may enter the picture: long-term care. Many households put off thinking about long-term care because it feels distant. The need may never come, or it may come much later than expected. But the potential cost is difficult to ignore. According to CareScout's 2025 cost data, the national median cost of assisted living reached $74,400 per year. That figure helps explain why long-term care remains one of the largest financial uncertainties facing retirees. A single care event can place extraordinary pressure on savings. This does not mean every retiree will face those costs. It means the possibility exists, and the financial impact can be substantial. Viewed one by one, each expense may seem manageable. Home insurance, auto insurance, healthcare coverage, Medicare premiums, deductibles, potential long-term care costs. The hidden challenge appears when they begin stacking together. That stacking effect of the real story. It helps explain why some households feel stretched even when they have avoided major mistakes. It helps explain why people who worked hard, saved consistently, and acted responsibly may still feel pressure. And it helps explain why retirement planning is becoming more of a cash flow conversation, not only a savings conversation. Many Americans believe retirement risk comes from doing something wrong, but the evidence in this story points to another possibility. Sometimes the pressure comes from necessary expenses becoming larger than expected. Sometimes the danger is not overspending. Sometimes the danger is a shrinking margin for error. That is why one of the most important mindset shifts is recognizing insurance for what it has become. Not just a protection product, not just another line item on a budget, but an ongoing retirement expense that deserves the same attention as housing, healthcare, and income planning. This is not about panic. It is not about assuming every insurance bill will become unmanageable. And it does not mean retirement is impossible. It means paying attention earlier. Because the problem is not always obvious at first. The home may be paid off, the career may be ending, retirement may finally be within reach. But the insurance bill keeps arriving, month after month, year after year, quietly, and for many middle-class Americans, that may be one of the most important financial fault lines to understand before retirement begins.